For me, a lot of it is not taking the time to be strategic, talking with somebody else that knows the rules, that can help you out so that you can figure out, okay, does the 1031 exchange make sense in this case? Or maybe it's just better to pay the capital gains because I've got $700,000 worth of capital losses somewhere else that are going to just eat into that gain.
What's the biggest frustration you've seen when it comes to clients? And it could be selling cryptocurrency, businesses, real estate, with capital gains tax deferral and or the 1031 exchange.
Well, I think the biggest thing is a lot of people don't plan ahead. So when I'm looking at, like, when I've got people retiring, they've got some rental property, we take a look at, do we want to, maybe we sell the main house and get that 250 or 500,000 exemption and then move into the rental property. And maybe we're going to live in that till we pass or something, but trying to defer that gain is something that a lot of people don't think about. They're like, well, I don't really want to move. I don't want to do that. That's inconvenient. And to me, it's about really being strategic. I'm surprised how many people don't know the rules. And I think if you're going to invest, no matter what you're doing, find out the rules or work with somebody that does know the rules. I had a guy that sold about a couple $1 million worth of stocks, and he sold them a day short of a long-term capital gain. And he'd been trading for years. And so I said to him, what happened here? Why didn't you wait the extra day? He's like, what are you talking about? I said, wait a minute. You don't know that if you hold it a year and a day, it's a long-term? He goes, oh, I never heard that rule. I said, well, this is how much extra you're paying in tax. He's like, oh, I won't forget that. But it's to me, this last year, so many people got hit with, I had several clients with $750, $1 million worth of wash sales. And I'm like, you owe a lot of money. They're like, no, I had losses. I said, no, you had wash sales. You didn't pay attention. And so I saw that as a really big problem this year. And so for me, a lot of it is not taking the time to be strategic, talking with somebody else that knows the rules, that can help you out so that you can figure out, okay, does the 1031 exchange make sense in this case? Or maybe it's just better to pay the capital gains because I've got $700,000 worth of capital losses somewhere else that are going to just eat into that gain. Because a lot of people don't take that into consideration. When I'm working with advisors, I'm always saying, let's look at any capital loss carry forward before we decide what losses we're going to cultivate.
Very, very well said. So not taking the time to plan, and maybe it's inconvenient if it's the 121 exclusion, lived in a house too the last 5 years. That's what Bob was referring to. You have a $500,000, tax exemption, right? Which is really nice. So if you bought a house for $1 million and you sell it for 1.5, hey, you're good. There's no tax if you lived there the last 5 years and you're married. You mentioned wash sales. I want to make sure our clients aren't missing that, right? And by the way, we have a solution for the Deferred Sales Trust, or the Deferred Sales Trust, to defer public or private stock, and also cryptocurrency, not using a 1031 exchange. So if anyone's thinking, oh no, I'm going to sell some public stock, but I want to defer the capital gains tax, we can do that. You can go to capitalgainstaxsolutions.com. But let's talk about the wash sales there, Bob. Like, define that so make sure people understand exactly what you're saying.
Yeah. So if I go out and let's say, just for example, I sell some Apple stock, and that's probably not realistic, but I sell some Apple stock and I lose a whole bunch of money. I sold, 50 shares and I lose all this money. And then within 30 days, I go out and buy more Apple stock. And I'm thinking I'm going to get to capture all these losses that I just picked up. And I got so smart. Within 30 days, I bought some more stock. You're not going to get to recognize that loss when you come tax time. You're going to have to wait. That's going to get kicked down the pike. And so what happens is people think they're going to capture all these losses. And if they've done it within 30 days, they will not be seeing those losses.
Okay, got it. So you want to make sure that it's 30 days or more. So if I bought Apple stock, let's say for $1 million, and it dropped to 800,000, and I was like, oh, I'll take that loss there, and I immediately bought something else, at the low, and it rode up to 400,000, right?
Right.
Doesn't matter. You're not going to be able to just sell at 400,000 and offset 200 of that.
That's right.
Because you bought it. But had I bought that same stock 31 days from the time that I sold,
that's right,
and the same thing happened, then I'd be able to write it off. Is that a fair summary?
That's absolutely right.